Hmm. Oh, is it time to do another Q&A video?
Hey everybody, Ryan Bolton here, local mortgage expert, ryanbolton.com. I help people finance homes in Utah and Nevada. So if you're looking to buy in Utah or Nevada, I'd love to work with you. My team is out of California. We have our corporate office out of San Diego. My team's out of LA as well. But we also loan throughout many different states. So if you need any kind of help with real estate financing, I would love to help you either personally or I can direct you to the person within our company. But I'd love to answer any questions you might have about real estate and then direct you where you need to go. But especially Utah, Nevada, that's where I can help you directly on getting a mortgage loan. So give me a call or check out my website at ryanbolton.com. There's a great scheduler there. Love to earn your business. We got home equity lines of credit. We got these great mobile apps to help with budgeting and mortgage calculators, all kinds of fun stuff. So check out my website, ryanbolton.com. So let's just see how many questions we can answer today. I had a few submitted to my YouTube channel. I wanted to do this one I found that was actually pretty good. So it says this: my current mortgage rate is 4.5%. Is it a good time to refinance? Now, many people, when they hear that, would say, oh, no. It's a horrible time to refinance if you have 4.5%. And I would say it depends. Like, how long do you plan on keeping the home? How are you pulling out money to do home improvements? Are you trying to improve the asset or the use of the home? Because I've had some people that maybe have 4.5%, but it's a $200,000 loan, and they need to either sell it and get a higher rate and or pay way more for the next house, where they better off just taking the money out and doing the remodeling of the home. Yeah, it might raise the rate to 7% or something like that, but they get more use out of the home, more value out of the home. They get other use of the money. So the answer in real estate, it depends. There's so many things that factor into real estate. There's not just a hard and fast rule of whether it makes sense to refinance. Just because you're going from 4.5 to say 7% on the interest rate isn't a hard, fast, no, you shouldn't refinance no matter what. But what if you're getting rid of $1,000 worth of other debt that then you can put more money into savings or emergency, or you can put that money back towards a mortgage and pay it off faster than you were trying to pay it off at 4.5%. So there isn't, I wouldn't say it's a hard no. Now it's harder, sure. It's harder if you're going from 4.5 to 7. There's got to be a lot more benefits to offset that. But there is times where I've seen clients do that and will do that over the next few years, because they either want to keep their home, remodel it, pay off other debts, tap into some of the equity, use it for other investments. What if you pulled out the 100 grand, you found an investment that paid you more than 7%, or bought another piece of real estate? Or a big one is getting rid of all these other debts you're paying way higher than 7% on the interest rate on. So just because you have a 3 or 4% interest rate doesn't mean it's a hard and fast, never refinance that loan again. There is ways that make sense depending on where the money's going and depending on the benefit of that loan. All right, next one. So that was a great question. I think too many times people just hard and fast, nope, don't refi. You already have a 4.5. Don't go to 6. Don't go to 7. It depends. It really does depend. All right. Another time, I get this question a lot, and maybe I'm just not answering it correctly, but here's the question. Can I get a new home loan even though I have an existing home loan? I'm amazed how many people think you can't sell or can't refinance because you already have a loan on the property. So you do not have to have the property free and clear to sell it. You do not have to have it free and clear to add a mortgage or refinance or do something with it. So just like a car loan or other loans, if you owe, say, $200,000 on it, the home's worth $4, you can do a loan that refinances this loan and either pull out the cash or pay off other debts or just lower the rate, whatever it might be, with this new loan. So this loan replaces this one. The refinance is taking this loan and getting it better terms, better rates, more money back out, whatever the reason to do the refinance would be. Doesn't have to be free and clear. You don't have to wait till your home's free and clear to sell. You don't have to wait till it's free and clear to refinance or pull cash out. Now, sometimes you can just do a second mortgage. So you have this first mortgage you used to buy the home, let's say 5-10 years down the road. You don't want to refinance this for whatever reason, doesn't make enough sense. You can add a second mortgage. So this question comes up a lot, that you have to have it free and clear to sell, or you have to have it free and clear that you already have a mortgage, so you can't get another mortgage or replace that mortgage with a new mortgage. All that happens with the title company. Work with your lender. We know how to do. I do that on a daily basis, where we're showing, okay, we owe this much on the home. We're going to refinance, pull out the money. That loan gets paid off as part of that process. So it's not like you got a $400,000 first and this new $400,000 loan without paying this one off first. So you either got to sell it for more than the balance, or the new loan that's replacing this one has to be big enough to cover it. So usually refinances raise the balance, But again, if it's enough benefit with cash back or interest rate reduction or term reduction or reinvesting the money somewhere else or debt consolidation, all the reasons to refinances are out there. Okay, this one's one that was submitted to my Facebook channel. Why is investment property financing more expensive than regular housing financing? The simple answer to that, the risk is higher. So let's say you're a real estate investor. Let's say you got your primary residence. That's where your wife and kids and dog and everybody is. That's kind of your primary home. And you've got this rental over here. You have this rental that you're making. Let's say the renters trash the place or something happens where they can't make their rent. And all of a sudden they start just squatting in the property where they won't leave, but they won't pay rent. You have to evict them and go through all this process. Which payment are you more likely to miss on the mortgage? The home you're living in or this home that's kind of a problem child? Or one that's got deferred maintenance, or just can't rent, or you lose your job and you just can't make your payment, or health becomes an issue, whatever it is. It's way more common for people to start missing payments, properties get more distressed, more deferred maintenance, more problems on investment properties than on a primary residence, the home you're living in and day out. So because of that, the risk is higher. Down payment requirements are usually higher. They just want a little more skin in the game. The rates are a little higher to offset that risk. There's some investors that don't even want that type of occupancy. So part of that is just that's why the rates and terms are worse on investment properties than on a primary residence. Let's see. Does mortgage refinance reset loan term back to 360 months or 30 years? So most refinancing does. So if you've been in the house for, say, 3 years, so you have 27 years left on your mortgage, if you refinance it, almost all of them are 30-year fixed. You're basically going to a 30-year fixed rate loan. Now, you can do a different term. Like a lot of lenders will do a 25-year term, a 20-year term. I've even seen lenders that'll do in between. They'll do a 26, 27, 28, 29-year term. But it's much, much more common to do a 30-year fixed. So yes, the new loan is a 30. It doesn't really reset your old one. It's just the balance that you have is now on a 30-year loan. So it does go back to a 30-year term. So what I usually recommend is look at doing a 25-year term. You know, if you're saving enough money on the refinance or other debts, that's a great way to make sure you're not going backwards on the loan. It doesn't usually help your rate. So it's not going to see a rate reduction to do that. But if you're already saving some money by paying off other debt, doing a 25-year term is helpful. The first 5 years on a mortgage is a lot of interest anyway. So a 25-year term can make it so you're not going backwards. But just check your term. Almost every refinance usually goes back to a 30-year fixed. Let's see. Is it a good time to buy a home when prices are down, but interest rates are up? Yes. And again, probably the answer is it depends. Depends on the house. Depends on the price of that house. Depends on the use of the house, how long you're going to be in that house. But I tell people all the time, don't wait to buy real estate. Buy real estate, then wait. There's nobody that's lost on real estate now since 2008. And even 2008, anybody that was able to stick it out or play through that time frame has recovered within 2 years. I think there's very few places where you didn't see a recovery within that time frame. But over the last 10 years, 20 years, most of human history, or at least mortgage loan and real estate history, especially in the United States, values have gone up. Now you're going to have pockets. Real estate is still local. What's happening in Detroit is not what's happening in Vegas or happening in LA or San Francisco or places where people are moving out of. So look at your real estate market, of course. It's much more local in what's going on just nationally, but it is something where real estate wins in the long run. If you're moving in, if you're renting versus owning, you're 110% interest by the time you don't get any appreciation, by no tax benefits for renting. So it's something where you gain net worth with owning real estate more than anything else. But more importantly than even that is the payment's way more consistent on a mortgage. You're a 30-year fixed rate. Now, maybe the taxes, insurance, HOA, those might change a little bit, but they're so much smaller than rent increases. I've seen rent double on some of these houses or go up dramatically. Maybe it doesn't go up for the first or second year, and then all of a sudden, bam, it goes up double or goes up $500. You'll never see a mortgage go up that much, a 30-year fixed rate mortgage. You're never going to see property tax, insurance, HOA go up that much that you do on rental income or rental properties. So it's just better to own. You get the appreciation, you get the locked in fixed payment. So what do you, everybody's so worried. Okay, yeah, I buy this house for 4, it goes down to 350. Yeah, that sucks. But it's only worth what somebody's willing to pay for. And if you're not selling anyway, the payment is what really matters. What's a comfortable payment? What can fit within your budget? And many, many times you can't replace that home with the payment that you got. If you get into a house for 2 years and you go try to rent the similar home, it's going to be usually more than what you're paying in a mortgage. So maybe up front, there's a little bit of that. You're paying more than what you would for rent, but eventually it always overlaps it, and it's more consistent. It's just a much more locked in payment than any other type of housing expense that's out there. So soapbox time here, people. Two sayings I say all the time. Don't wait to buy real estate. Buy real estate, then wait. Now, sometimes you got to wait longer, sometimes shorter, but you'll always win in the long run. And second of all, the best time to buy real estate. You ready for this? The best time to buy real estate was 6 months ago. It was. Everybody's looking right now, maybe even 12 months ago because of interest rates, but 6 months ago, it probably was cheaper, or maybe rates were better. I mean, it's amazing how often that happens. There's windows where maybe it doesn't, but it's a general rule of thumb. The best time to buy real estate was 6 months ago. The next best time is right now. Right now. Go get approved. You wait 12. What do you think is going to be better in 12 months? Especially in the price range where most people are hoping that values go down. They're hoping that $400,000 home is going to go to $200,000. That's not going to happen. Now, $1.5 million home going down to maybe $1.2 million, that's more likely because you get less buyers that can even afford that price range as rates go up. But in the lower price ranges, you're not going to see these huge reduction in value. You're not going to see huge drops. You might see it level off where it really doesn't go up. And they're not building homes in those price ranges much. They just can't even build them with land price costs, labor costs, although it's just so tough to build homes in that price range unless you're getting the land for just nothing. Because that's one of the hard costs. The land costs this and everything else just kind of gets added on top of it. So buy real estate. I'm telling you, buy real estate 12 months from now, 24 months from now, you will be better off. I'm sure of it. All right. Soapbox over. All right. Let's see what else we got here. Oh, let's jump into another section. Let's jump on Quora. It's a great little website here that has a lot of really good questions. Is 2.5% a good rate for a 15-year mortgage? That's fantastic. I mean, come on. 2.5%. What I would say here too is it depends also on the cost. So if you're 2.5%, but it costs you 5 points or something like that, then that's where you have to figure out where's the break-even point for the cost of the loan versus the savings I get from not buying down their interest rate. But yeah, if it's 2.5% with like normal fees and not really buying down the interest rate that far, that's a fantastic interest rate today. And I would say that's probably not a fixed. I don't even know what would get down that low. So I wonder if that's an old question, because that is just crazy to see that kind of rate, even on a 15-year term. Let's see. Can you refinance a home loan with the same bank if you already paid off part of the loan? Yes, of course you can. Whatever the remaining balance is would just roll into a new loan. So a refinance is just taking your existing balance, whether you paid it down, paid it way down, haven't paid anything but your minimum payment, whatever the balance is, the new refinance loan pays off that loan. And you don't have to use the same bank. You don't have to use the same lender. I mean, you might want to talk to the same loan officer, because a lot of times the loan officers will originate the loans. They get packaged up and then sold to servicers or transferred or whatever it might be. So it depends. If you have a great relationship with that loan officer, try to reach out to them again. But you don't have to use the lender that's servicing your loan. So if your loan was sold to Mr. Cooper or all the other ones out there, Wells Fargo, Chase, whoever it is, you don't get an automatic better loan by using the current lender. They bought that loan. It's just a security. If you go to refinance, they still have to go through the same hoops. They still got to verify income, assets, appraisal, title, homeowner's insurance. It really doesn't make a big difference. So, and really, I tell people all the time, we all get the money from the same sources. It's not like the money I'm getting to loan my clients is different than anybody else. That's really not what separates mortgage companies. What separates them is knowledge, answering the phone, answering emails, product availability. So maybe it's something where you've got a little niche in your income, self-employed, for instance, or credit issues, or location or occupancy type. Those are the types of things that can differentiate lenders a little bit. But it is something where most of it's going to be down to the loan officer you're using. That's really what separates most of us. Answer the phone, answer the emails, answer your questions. That's going to separate way more than, say, interest rate, because we're all getting the money. We're all getting the guidelines. We're all getting the sources are all the same. It's not like there's dramatic different pricing every single day. Now, niche products might be different. Sure, there might be some portfolio stuff that's a little bit different. When it comes to FHA, VA, USDA, conventional loans, we're all getting the money from the same sources, and we're checking everybody. There's nobody that's way off when it comes to interest rate. All right, 14 minutes. Let's see what else we can answer. Hope you're enjoying the video. Please like, click, subscribe. Love to do these videos, so love to answer any questions you might have. Let's jump on to another section here. Can I apply for an auto loan right after closing on a home loan? Yes, after. So it is something where I can't tell you how many times we have clients that get approved. They say they're approved. They haven't signed their loan documents yet. We don't have the appraisal back, and they go out and get a credit card for furniture or appliances, or I've seen the craziest ones where they're getting 10% off their purchase or something and get a credit card. So during the process, please do not pull your credit. Please do not uh, apply for new loans. Don't refinance auto loans. Don't pay down loans. If you have money sitting in savings and you want to pay down a loan, talk with your loan officer first. A lot of times having the money in the bank will strengthen your file more than getting rid of a debt. If you still need to get rid of the debt to qualify, you can do it at closing. Don't do it beforehand. Just better to just kind of keep everything, save the pennies, keep everything status quo. It just will save you a lot of paperwork and headache down the road. But after the loan's done, closed, recorded, underwritten, you got the keys, you've moved in, go apply for an auto loan if you want to. Go apply for even whatever else you need to do. So, but do it after. That's such a crucial part. Do it after. Talk with your loan officer first. Just do it after. All right, 16 minutes. I try to keep these to about 20 minutes or so. Let's see. How many credit points does it take to get a solid home loan? Great question. Most of the average credit scores in the country, every state's a little different. I remember seeing a report that showed which states are the highest and lowest average credit scores, but right about 680 is where you start getting into the averages. Well, when you start getting into the 760 or better, you're in pretty much the top tier. There's very few lenders that will do a different loan or different rate if you're over 760. Most 740 is really probably the top tier, but there's a few out there if you're 760 or better. That's when you start seeing maybe cheaper things or leniency and other things. But if you're talking solid home loan, 760 is the magic number. If you can get to 760, that's going to get you the best pricing, easiest underwriting, best guidelines when you get to that credit score. But if you don't get to at least 680, you're going to limit yourself on what type of loans are accepted. Now, some of the government-backed loans like VA, FHA, USDA, these types of loans aren't necessarily credit score driven. They're credit history driven, but investors still like to see those minimum scores. Most credit is based on 20-point tiers. So you're getting the same guidelines and loan amounts and underwriting guidelines, debt ratio requirements, all that within 20-point increments. So if you're a 641, you're getting the same loan up to 659. Once you get to 660, now you're in the same tier up to 679, and so on and so forth. So they're kind of these 20-point increments. So really, you're getting basically the same loan at 685 or 692. You're still in that tier. So anything 740 and a better, that's where you're going to get the most solid loans. All right. How do I write a letter to get a list of documents for a home loan? How do I write a letter? So when I get a client in my office, we review their situation. Sometimes I need different documentation depending on the client's income, or maybe we need something on their credit or their down payment source. I mean, money for down payment can come from selling a home, savings, grants, down payment assistance, 401k loans. So there's a lot of different documents that wouldn't apply to everybody's situation. So part of my job is to take the client's situation and see, okay, here's the documentation we'll need for the best loan we can get. If we can't provide this documentation or it doesn't fit the box, then we kind of look at what other loan programs fit the client's needs. So there isn't just a straight list of documents. There's always going to be, where's your down payment coming from? That's always going to be something. You're going to have, how's your income generated? Now, there's loans that don't require that, but the rates and terms are going to be worse. So everything's going to have guidelines to verify what's on the application. Verify your income, how long you've been on the job, your ID to make sure you're old enough and that we're really talking to the right person, pulling credit, checking debt ratio, checking down payment source, checking how long you've been on your job, how likely your job's going to continue. There's a lot that goes into a mortgage loan. You're talking hundreds of thousands of dollars that we're loaning, and we're getting back $1,000 a month. You know what I mean? So there is stuff there that we have to follow as far as guidelines. But as far as just a general list, that's great, but you may be getting stuff you really don't need or don't have and think, oh, well, I don't have that, so I can't get the loan. You want to talk to a loan officer. You want to get a referral or talk with me, call me, check out my website where you can schedule an appointment to meet or talk. And I can give you a list of what you're most likely going to need based on what program you're trying to qualify for. So That's the most helpful advice. Don't go on a wild goose chase on trying to get documents you may not need, and vice versa. You may need documents you can't get, so then you have to do different loan programs. But there's lenders out there for almost every type of scenario. So it's just a matter of finding the best rates and terms for your needs and what you can actually qualify for. I think we're going to be out of time. Oh, look at that. Right at about 20 minutes. Perfect. So I hope you enjoyed the video. I really enjoy doing these. I hope these are great questions. And if you have a question, comment, concern, please post in the comments. I'll get to those in a future video. Like, subscribe, share to your friends. And if you need help with a mortgage loan, call me. I can do directly lending in Utah, Nevada. That's where I'm individually licensed, but our company's licensed throughout almost the whole country. So I can answer questions, direct you to the right person, but I want to earn your business by showing the passion I have for this. I really enjoy doing real estate and really want to help you. Just, it's time to buy. Buy a piece of property. Do not wait. Remember what we said? Don't wait to buy real estate. Buy real estate, then wait. Hope you have a wonderful day, and we'll see you next time.